Welcome back to Rockstock Channel. It is Friday, September 12th, and we are recording from a new location today here at Rockefeller Center, the place where the Martha Stewart podcast is broadcast on a weekly basis. I visited here a couple of months ago and thought this might be a cool opportunity to interview from one day when a colleague or client of mine are in town, and luckily we have two of that here. So we have Matt Fernley is with me in New York, and we have a docket that's going to include the metals company's CFO, Craig Shesky, for I think maybe the 8th time we're having on Rockstock Channel, and we'll also be interviewing Ernie Ortiz of Lithium Royalty Corp to talk about the lithium volatility this month, quarter, last number of weeks, but in particular this week's CATL restart of lepidolite, thoughts and rumors that have had many lithium stocks down 10 to 20%. But first, Matt, as we've discussed before, is helping RK Equity, has joined as a partner, not only deepen our lithium expertise, but broaden our coverage of many other commodities, and has started a blog on RK Equity's website and has been publishing on a weekly or so basis. And earlier this week, he published a rare earths blog, which he's going to talk about here. That is available at blog.rkequity.com. I would encourage all our viewers to visit that website to pull that off, but also to, if you want the Lithium Bull, which we publish monthly, visit the main RK Equity website, rkequity.com, and register your email for that. And before we begin, just a reminder, we will talk about certain stocks, including IperionX and the metals company and perhaps a few others. And we are an advisor to the metals company, and Lithium Royalty Corp has been a client of ours in the past. We are shareholders in the metals company, but nothing you're going to hear today is financial advice. Please consult the disclaimer at the end of this video. And if you like this video, just a reminder, please like and comment on it, and feel free to subscribe to the channel, and hit the notification bell so you can be alerted to all of our videos when they are out there. So, Matt, with that, welcome. Great to see finally you received your Rockstock Channel
I've got my hat. I've got my hat.
So tell us about your latest blog. And by the way, that blog follows earlier blogs that we did that you wrote about brine versus hard rock, where you flagged the undervaluation of brines such as Galan Lithium and NOAA and Lithium Argentina to some of the hard rock stories. And you also wrote a note about DMS versus flotation in the hard rock space, flagging companies like Q2 Metals and a few others. But so the rare earth story, please let us know what you've said there.
Yeah, I mean, I'll just come back to the lithium blogs. Again, the lithium blogs are focused on a thematic that we've been discussing for a while, which is that, for this recovery in lithium prices, such as it is, we would suggest having exposure primarily to lower cost producers, or rather I would suggest primarily having exposure to lower cost producers. And obviously the brine lithium guys are lower cost assets, and the guys in hard rock that can use DMS only tend to be lower cost assets as well. So again, that's focusing on this lower cost thematic. But anyway, moving on to the rare earth article now, and I think one of the things that I've come up against many times in the industry over the years is that the rare earth segment is an extremely complex segment. And a lot of investors sort of looking into it from outside don't really understand how to value stocks. And there's a lot of, I want to say misinformation, but poor information out there in terms of how to look at early stage stocks. I'm not really talking about production stocks like Lynas and MP, where I can build a DCF valuation, or I can do an earnings forecast to let me know what the EV/EBITDA or PE multiple is. I'm really talking about the early stage sort of exploration stocks, potentially exploration into development stocks. How do you compare those one to another? How do you know what looks like a really interesting stock compared to other stocks in the sector? And I think the big issue that I would suggest that people are aware of is that different rare earth elements trade at different prices. So, for instance, most rare earth stocks in the world, the ore bodies are concentrated in what we call light rare earths, like cerium and lanthanum. The problem is that cerium and lanthanum prices are a fraction of the magnet metals like neodymium, praseodymium, terbium, and dysprosium. So how then do you value a stock if people look at rare earths on a sort of total rare earth oxide basis? And my contention is you don't look at it on a total rare earth oxide basis. You look at it on a neodymium praseodymium basis, and also within that you calculate what the neodymium praseodymium, so NdPr for people who don't want to keep saying neodymium praseodymium, you look at it on an NdPr-equivalent basis. So what you can do is you can calculate the prices of all of these lanthanide elements and some of the additional hangers-on that we include as rare earths, and then you can look at them as a function or as a fraction of what the NdPr prices are, and that allows you to calculate an NdPr equivalent grade, which you then apply to your valuations. And a lot of analysts, they look at EV, but I suggest that potentially for early stage stocks, the market cap over the contained resource of NdPr equivalent is a great way of looking at companies. And if you do the calculations, or for instance, if you look at the valuation sheet that is available in Battery Materials Review, will be available going forward via the RK Equity website, something that we'll update regularly. You can get a pretty good idea as to which stocks look the most interesting. And there is a very clear differentiation when you look at on an NdPr equivalent basis between, for instance, the hard rock assets that are in production at the moment and the hard rock assets that are being developed. And you can understand why some of these hard rock assets that are being developed or are still at the exploration stage have been left on the shelf when you look at it on an NdPr equivalent basis rather than looking at it on a total rare earth oxide basis. And then also a commentary on some of the ionic absorption clay stocks, again, because those are enriched in heavy rare earths. You can also, again, get an idea for why, specific projects are more interesting than other specific projects. And then at the end of the article, there's just a few issues to watch out for that investors should be aware of in the rare earth space.
Great. Thanks, Matt, for that. As we've said, we're definitely diversifying outside of lithium, and rare earths has been a major focus of ours, and we're talking to a number of rare earths companies and finding ones which we think are interesting to bring to our viewers in the not too distant future. I want to turn to our site visit to IperionX, which is a company I was involved with from its formation when it was Tau Commodities, and then it was called Hyperion, now IperionX. But Tau Commodities originally was and still is a mineral sands mine in Tennessee, which has some heavy rare earths in that. But they pivoted their story from building a mine first and then building downstream processing to actually build downstream processing first in a capital light strategy using a very large amount of titanium scrap, which is available in America, which they could buy, very cheaply. So they pivoted the idea and have received very substantial funding from equity investors, including Fidelity International, and B. Riley, but also the Department of Defense, the state of Virginia, in terms of not only money, but cheap land. But it was very impressive to see that money being put to work in a capital light strategy where they are taking, titanium scrap and then converting that to titanium powder in building number one, and then in building number two, taking that titanium powder and then using 3D printing and stamping machines, creating bespoke products for some of their customers, which publicly announced they have Ford and Lockheed Martin as customers, and also some in the U.S. Army, I think. So some precision type products, including golf club heads and watch faces, and but also what we call rivets and fasteners. I have a note here, which I read a bunch of their research. I think Petra Capital and Canaccord and Bell Potter have raised some capital and have written on the notes on them. But I found this one, in Petra Capital, which I'll hold up here. If anyone wants any of this research on IperionX, feel free to visit or email us at rockstockchannel@rkequity.com, and I could share that with you. But there's a March note here that says kind of fasteners, the opportunity is nuts, which I love double entendres, so I really like that analogy. But they were comparing a company called Howmet, which is a 75 billion market cap company in the U.S. now, 75 billion, has doubled in price over the past year as they control this market. Or it was an oligopoly of like 3 players, but that division has 1.6 billion in revenue and $400 million of EBITDA, and relatively high margins. And there's an EV to EBITDA, on this company of some like 25%. So if IperionX is able to produce fasteners at a 90% discount through IperionX story is they're looking to disrupt with new technology. And actually, you could talk about this maybe more specifically, Matt, the hammer process and the HPSC process. But the bottom line is the big idea of IperionX is to substantially lower the cost of titanium so that it can compete with aluminum and stainless steel. And one of the ways to, with very substantially fewer steps in the flow sheet process. And so Petra is talking about a commodity-like process, like making not even precision, parts, but just these fasteners. It's a huge market, and if IperionX could, tap into that specific market, the opportunity. Comparing it to Howmet, a 75 billion market cap company from a 1.3 billion U.S. market cap company that IperionX is today, demonstrates a fair bit of that blue sky. But anyway, that's my, just quick assessment. But Matt, you barely knew this story ahead of time. I've been involved with it for 3 or 4 years. What were your thoughts having visited it?
Well, I think the big issue with technology disruptors is, we hear quite regularly, oh, this company is brilliant. We've got a new way of doing it. We're completely going to disrupt the existing status quo. And obviously, the big issue with technology disruptors is the proof is in the pudding. Can you actually do what you said you were going to do? Having gone along to the IperionX facilities over a couple of days ago, I can confirm that they are doing what they said they were going to do, and I think that's a major takeaway. And the company is producing titanium. What would you call it? Fasteners and products, and sending them off to customers for qualification. And I want to emphasize here that the qualification for titanium products is not like qualification for batteries. We're not talking like 12 to 18 months of qualification. We're talking, maybe a couple of weeks or months of qualification. So the big takeaway is that they're in production on these products, and they appear to be in production for significantly less cost than the incumbents are producing at in the market. And obviously, if you can produce products of similar qualities for considerably lower cost, you have the potential to either be really going out at a very high profit margin level and making loads of cash, or potentially undercutting your competition and still making quite a lot of cash. So really what came out to me is the upside blue sky potential from this asset. And at the moment, titanium competes in certain applications with stainless steel and aluminium. And as we know, the stainless steel and aluminium markets are huge. And for me, there is a considerable amount of blue sky potential in this company, which is not necessarily being recognized in analyst notes at the moment. So, that was really what came away from me on the site visit: the blue sky upside, but also the ability to execute what they said that they were going to execute. I should mention that I came straight out of the site visit and bought the stock. So that probably gives an indication of how convinced I was by what they were doing.
That's good to hear. I've owned it for quite some time and was involved in this company, again, as I said, from inception, because the founder of the company, Tazo Arima, is someone I've done business with for about 15 years, since he was in his late 20s. He's still under 40, but he was involved in Coalspur, which was a thermal coal story in Alberta, exporting now to Korea. Then he founded Piedmont Lithium, approached me, and we helped raise some seed funding and helped bring in Keith Phillips as the CEO of that company, which just merged with Sayona. But Tazo and his chairman, Todd Hannigan, is someone I've come to get to know, and was good to see him as well. They've built a very great team here. And like so many, the U.S. Does not have a lot of these kind of like mining and processing, entrepreneurs. So I've talked about these Crocodile Dundee Australians kind of coming to America. I've also, so Tazo is a repeat performer. And this is his biggest idea, and there's still kind of quite a ways to go here. In the video we did with Tazo last April, I compared him to Hank Rearden, the fictional character in Ayn Rand's Fountainhead, which actually is relevant because Hank Rearden came up with a new metal alloy that was focused on the steel and aluminum industries. But real life Hank Rearden is like Andrew Carnegie and Henry Bessemer. I mean, in IperionX's writings, they talk about what they're doing with the hammer process is a Bessemer moment for titanium. And the Bessemer moment was, a reduction in steel prices through innovative technology. The Kroll process, which is currently used in titanium, is a very old process. And I visited the University of Utah 4 years ago during the pandemic, and saw the lab and then saw the pilot plant. Soon after that, they acquired the technology and have spent all of this time now commercializing it. And so this could easily, I think it could be a 10 billion or more opportunity as they're going to have first revenues in the next kind of couple of months. And a lot of what we saw, the 3D printing and the stamping machines, there are 7 or 8 different machines making multiple products, right? They like which market segments they're going to go after, they're going to determine. They're now proving the process, but they're proving it with some very high profile customers, and it looks, very, very exciting. So with that, any comment on the heavy rare earth side? Because you mentioned, DYTB as relevant. Again, going back, originally this story was meant to be a mineral sands, project, going into production, and then they decided to use the recycled scrap. But they do have funding from the Department of Defense to advance their Titan project to definitive feasibility study, which is sometime next year. And within that, there's titanium in that will feed the titanium plant, but there are also byproducts of heavy rare earths, which are a bit of a missing ingredient to the magnet supply chain that MP Materials is focused on. So I've made some comparisons between MP and IperionX, but I don't think you bought some shares. But investors who are watching this, who are invested in either MP or the generalist retail investor, as well as the guest we're going to interview shortly, TMC. Hyperion is listed in Australia. They've raised money to some degree with U.S. investors, but it's not well known, with
and
generalist
have an ADR
retail.
here.
And they do have an ADR here, and I think a step to realize the blue sky potential that you're talking about is to access more of that generalist retail investor and perhaps some of our audience, will make note of that. And again, if you're interested, we can give you some more information. But there is a rare earth kicker potentially within the titanium story through this titanium or the Titan deposit. So if you could just talk briefly about that.
Yeah, I mean, I think for me, the rare earth is sort of like a byproduct of the titanium focus. But certainly there is evidence that the mineral sands deposit has monazite in there, monazite concentrate potentially, which does contain rare earth minerals. And certainly there's potential to supply rare earths to a mill that could process them. So something like the White Mesa mill, which is operated by Energy Fuels in the US, or one of other mills that are operated elsewhere that can convert monazite concentrate into rare earth metals. So yeah, I mean, I see, for me, the potential of the rare earth stream is small compared to what they can do in titanium, but potentially it could be an interesting source of rare earths for the US in the near term.
Great. And with that, we're going to turn briefly, take a short break and bring in Craig Shesky, the CFO of the metals company. But just one last comment is that, again, IperionX has attracted a lot of government funding and government interest. And one takeaway of the meetings, Matt, that you and I have been having so far in New York and elsewhere, everyone, the bankers we're speaking to and the fund managers, there's a feeding frenzy. Everyone wants to list in America, and everyone wants to figure out how to access government funds. And the MP deal we've talked a lot about has been a bit, game changing, but there hasn't been like a coordinated approach yet coming out of America. Back under Biden, they had the Loan Programs Office. You could just knock on that door. You knew it was available. Navigating the Department of War now, not the Department of Defense, has been a bit more difficult. But our next guest, Craig Shesky, the metals company, has received a lot of positive endorsements from executive orders, but not yet any government money. So it's a question we're going to ask him. But overall, expect the U.S. government to be writing many more and bigger checks in coming months. And as an investment strategy, finding companies that are well connected with the U.S. government and likely to be selected for such funding are likely to garner substantial equity market interest.
And I think that's to some extent a chicken and egg thing, but obviously in some of these minor metals, because metal prices are currently at relatively low levels, it is difficult for these companies to source funding off the equity market. So the government being prepared to write checks and cut checks for these operations is very, very important. And it should result in equity market support, but then once you get the equity market support, then they can access additional funding streams. But certainly, the preparedness of the US government to cut checks contrasts very nicely with, for instance, what we've seen in Europe, where there's a long ongoing administrative process to try and access capital in the EU, which may or may not come to fruition anytime in the next couple of months. So, the fact that the U.S. government is willing to make funding available relatively quickly, I think is a very major differentiating factor for projects based in the U.S.
Great. And with that, I would love to hear an update from Craig and see, what his thoughts are on that process. Okay, welcome back, Craig. I think maybe the 7th or 8th time we have you, and very excited to have you here at the Rockefeller Center, joining us for the first time. And you might be sitting where Martha Stewart was sitting.
It's an honor, Howard, especially because of that.
So last I saw you was at your wonderful strategy day, which we produced 2 videos in relation to. So if you could just remind us, you successfully completed 2 economic studies, which were discussed in those interviews, but separately you received NOAA confirmation that TMC USA exploration license applications is fully compliant. Can you elaborate on that? And then we'll dig into what upcoming catalysts are on store for the rest of the year.
Absolutely, my pleasure. Well, look, the last 6 months have been very fast and furious when it came to news flow. It started really with the executive order from President Trump in April, noting that this administration wants to support the development of seabed resources using an existing seabed mining code that the U.S. put in place in the 1980s. So again, this is something where it's a confirmation of the political will to do something, as opposed to any new legal regime. This actually predates this United Nations / International Seabed Authority work on this topic, which is yet to be completed. So after that executive order, we launched our applications in late April for exploration licenses and a commercial recovery permit. Since that time, we've seen a regular cadence of headlines and incremental progress, maybe not the sort of very quick approval or even a rubber stamp approval that some people may have been hoping for, but really intention to go down this process in the right way in a very transparent manner to show, first of all, substantial compliance and then full compliance on our applications. NOAA, the National Oceanic and Atmospheric Administration, sits underneath the Commerce Department. They are our regulator. In fact, NOAA was really the pioneer for some of the environmental science in this space back in the 1970s. They also clarified some amendments to the Deep Seabed Hard Minerals Resources Act of 1980, and through those amendments made it clear that they have the ability to compress the timeline of review and also to review commercial recovery permits at the same time as exploration licenses. They just finished their public comment period on those amendments. So every month there's a new tick mark as we march closer to commercial production, which we anticipate to begin at the end, during the fourth quarter of 2027.
Great. So further, the NOAA has confirmed that TMC USA has priority right over both exploration areas.
That's correct. That's correct. It's very important. Look, what you don't want is to see that TMC, really through the work that we've been doing alongside our sponsoring states and our partners over the last 15 years, we've spent $600 million on this work to know the resource, to do 22 offshore environmental research campaigns, to do test mining, to do test processing. We wouldn't want somebody to then come in over the top rope and then try to take rights of that area. So it's very important not just to have rights over the area known as NORI and TOML, through which we have exploration contracts from the International Seabed Authority. We have rights through the U.S. now as well to those areas, at least a priority right while the application review is ongoing. It's very important for us to have that certainty. But in addition to that, we added what we estimate to be an extra few 100 million tons of potential resource for other areas outside of our existing NORI and TOML applications. So think of it as a 1.6 billion ton resource that has the potential to grow closer to 2 billion tons. And it's something that we believe is going to be in the low first quartile of the cost curve, with very attractive economics. In fact, nearly 24 billion net present value today, based on a recently released pre-feasibility study and initial assessment.
Sounds good. I have a few more questions here, but I want to bring Matt into the picture here. First time interviewing and actually meeting in person Craig, although Craig was a big reader of the Battery Materials Review for its coverage of, all the other metals outside of lithium that are contained within these nodules, including nickel, copper, cobalt, and manganese. So Go ahead, Matt.
Okay. Hi, Craig.
Hey, Matt.
So obviously, as long-time listeners will know, I've got a big thing for manganese and its importance in batteries. And obviously, we've heard over the last sort of 6 or 7 months or so about, the Ford and GM moving towards the manganese space and everything. And I think it's an area perhaps in your suite of products that doesn't get a lot of attention. So can you talk a little bit about the manganese potential of the ore bodies?
Yeah, I'd be happy to. Well, just looking at our pre-feasibility study, for example, manganese would represent roughly 30% of our expected future revenue. But that's assuming that the manganese that we would be selling is effectively a byproduct of the rotary kiln electric arc furnace process, whether that be at Pacific Metals in Japan, whether it be in South Korea, whether it be in Indonesia. There is the potential, and we've worked on flow sheets to take our manganese product and further refine it into manganese sulfate, and get a product that could be ready for the battery materials market. And obviously, I was very happy to hear there was a deep seabed mining panel at the Benchmark Week down in Washington, D.C. in June. And it was great to hear Kurt Kelty from GM talk about these LMR batteries, lithium manganese rich, which, as many listeners would know, would be about 65% manganese in the cell, 35% nickel. That's a great mix for what TMC's products could be. Yeah. So to us, it's not part of a flow sheet that you would see in any of our public disclosure, but we do have a flow sheet that could help us to pivot to a product like that and serve this growing market. Because as you've noted, it's pretty compelling to be able to say, here's a product that is roughly in cost parity with LFP batteries, with potentially, according to GM, 50% higher energy density per cell.
Well, yeah, I mean, I think that's a really important thing, definitely.
Okay. Any other besides manganese? You were talking about Korea zinc.
Isn't that enough?
Well, I always want to talk about nickel. Yeah. It depends, frankly, on which week, but you know, it's certainly been a lot on the nickel and the copper and the cobalt front. But that is really the nice thing about it. You know, we can focus on, you know, new headlines for all of these metal markets. Some of them are in vogue. Some of them fall out of favor. But when you have 4 metals in one resource, it does create a natural hedge and, frankly, quite a margin of safety when it comes to the economic viability of the project.
And we talked earlier about how important it is that there are other people, not just you, working in the sort of seabed mining area. And I mean, what does that mean for you when sort of guys like sort of Lockheed Martin and whatnot come out and say, well, we're looking at seabed mining as well? Yeah,
we find it very supportive overall for the narrative around this industry. Lockheed Martin was a pioneer in the space, really going back to the 1970s, when 4 separate consortia were collecting nodules at scale in the Clarion-Clipperton zone. Now, Lockheed Martin actually was granted an exploration license from NOAA in the 1980s. But Lockheed also sold some of their contract areas in the Pacific Ocean a couple of years back because they've been waiting for that vote of support from the U.S. government to show an indication that, you know, this is something the U.S. wants to do. And now we've seen that. And you've also seen Lockheed Martin's chief operating officer in the third quarter note that Lockheed is revisiting their seabed mining plans. They see the potential, and they are actively searching for partners to help develop some of their contract areas. So I think that's helpful. I think you've seen Transocean have some positive headlines in this industry. In fact, they devoted a drill ship to the collection of nodules after we did our successful collection test in late 2022. Credible names like that only add to the credibility that TMC and our partners, such as Allseas, Korea Zinc, Pacific Metals, Bechtel, it really adds to the suite of companies that can do this. And part of it's very important to see those U.S. companies do it, because if you're not a U.S. entity, or let's say you're a state-owned entity or supported, let's say, by the government of France or Germany or China, most of the other non-TMC actors in this space outside of the Cook Islands would be waiting for the International Seabed Authority to finish their seabed mining code to go forward. So really, there's an opportunity here where for the next 5+ years, TMC might be the only viable, actionable ground. And anybody who wants to get in this space, we would say, you know, we would welcome any conversations. But it's really on the prowess and capital and balance sheets of our partners that we've been able to progress this project as far as we have.
Okay, cool.
There was news recently from Tesla about battery technology advancing so that you can charge to 90% rather than 80%, and that those are nickel-based batteries. I think you posted a LinkedIn on that. I don't remember all the details, but if you can talk about that and how that impacts the nickel market.
Yeah, absolutely. Well, it's important to remember that for the nickel market, battery demand is still relatively small. Now, much of the expected growth in nickel demand would come from batteries. But I think there tends to be, at least from an investor perspective, and I would often fall into this trap when I was on the buy side, you want to pick one winner and that's it. Whereas, what you see from many of the actions of a GM or a Tesla or a Ford is a desire to be well hedged in terms of battery chemistries. LFP batteries, lithium iron phosphate, will make sense for a lot of vehicles. It won't make sense for a lot of other higher end vehicles. And it's not going to make much sense at all when, let's say, 10 years from now, if you're talking about level 4 autonomy, fully autonomous vehicles, well, one would expect that roughly half of the energy use of a vehicle would be for self-driving and other AI calculations as opposed to the powertrain. So when you have those power needs for full or even partial autonomy, using a higher energy density nickel battery makes a lot of sense. So what I think you've seen over the last few years is, using LFP where you can and saving nickel for the higher end, higher value vehicles. And for us, that's great. There's not going to be one particular chemistry that wins. And now you've seen nickel prices low enough over the last few years that it probably drew out more interest in LMR battery chemistries because people thought, well, shoot, if this is going to be roughly the same cost of LFP, why wouldn't I go for higher energy density?
Right. Okay. As a Tesla owner now for 2 months and having the full self-driving free for the first 3 months, I am going to subscribe to it for $100 a month because it is really awesome, right? And I listened to a podcast on the All In podcast or an interview with Elon Musk, and he's saying like the next version of the software, 14, is going to be orders of magnitude better than what is now. But it's like almost there, and so I'm a believer in robo-taxis and full autonomy in the not too distant future, and that means very higher use of the vehicles, and therefore will need nickel-based chemistries. And on another topic, their lithium hydroxide plant looks to be advancing, and that's a hydroxide-focused plant, which requires nickel-heavy batteries. So we were talking earlier about a major takeaway of our visits with some investors and investment banks here is that Washington is a hotbed of activity. Everyone's trying to tap into Washington, D.C. So you have had very substantial political rhetoric and executive orders and the like. I don't think, but no funding yet, right?
Correct.
With respect to the U.S. government, whereas some other companies, have been. But you've been very prominently in D.C. As we've seen. So if you could just talk about, I guess, permitting path and funding path as the final two questions.
Certainly. Well, on the permitting path, it is tied very much to the funding path. In fact, the executive order directed the Commerce Department and NOAA to accelerate permitting, while at the same time directing the Department of Defense, Department of Energy, Development Finance Corp, Exim Bank, you name it. Anybody with a big checkbook has been directed to focus on this space. Now, the funding discussions, what I would say is that they are ongoing, they are ripe. We do, of course, as a public company, it's not just funding at any cost, right? If you're talking about like an MP-style investment from the U.S. government, it has to be at the right price. It could be a combination of a direct investment along with, let's say, a guarantee to bring in some other public or private capital. It could also be an offtake. It could be purchase of nodules for a stockpile. There are a lot of different ways that you can arrange a fulsome suite of funding options to push this along. What I would say is that we had roughly $120 million of cash on the balance sheet as of the first week of July. Our cash position remains very strong, and we will make sure that any transaction potentially that we would do, or series of transactions with the U.S. government, would be at terms that our shareholders would support. So I can't say much more than we continue to go to D.C. quite often. I will be there in another few weeks. All of those conversations are happening. And frankly, many of the people who would be writing checks aren't even confirmed yet. There are some people who will be finally confirmed and in their seats this fall. And there are further appropriations for some of the agencies and cabinet departments that I named. There could be further appropriations from Congress to them that they're waiting for before they do the next MP materials style deal. So I would ask folks to be patient, but know that we are pulling on every thread possible.
I listened to an interview with Jim Latinsky, the CEO of MP Materials, and where he referenced the conversations that they had with the DoD, and the person leading that is ex-CEO of Cerberus, right, who is a pretty savvy negotiator, and negotiated a deal that was good for the U.S. taxpayer, but was also good for MP shareholders. So it was win-win, but it wasn't. I mean, Jim described it as the most intense. It wasn't like easy, like the government's giving away money. So Howard Lutnick at Commerce has talked about, it's not just loans, but we want this to be good for U.S. taxpayers as well as U.S. National security. So I think that was a win-win-win deal but they need to deliver, right? There's upside to the U.S. taxpayer with equity interest, et cetera. So good luck with those negotiations. But again, having been at Strategy Day, and one thing I emphasized in those videos was how impressed I was by not only Gerard, yourself, but the board from Steve Jurvetson and Michael Hess, and you have substantial gravitas across DC, savvy, and New York savvy, and Silicon Valley savvy, lawyers, entrepreneurs, deal doers. So if anyone has the capacity to pull off a MP style win-win-win kind of funding deal, I think it is your group.
Well, I would also just note, Howard, to close on that point, one thing that I can say definitively is that the U.S. government, in whichever form we're discussing with, they don't want to do, 1,000 small things. They're looking for the big needle movers. And it's undeniable that the resource that we can provide to the United States, it's sufficient to create total mineral independence when it comes to nickel, manganese, and cobalt, all three of which are deemed critical by the U.S. Geological Survey, and now add copper into the mix as of last month. So we feel very good that there could be something to do. But in any transaction, as we know, I was on the sell side of Morgan Stanley. I was on the buy side at King Street. Actually worked with Ryan Corbett, CFO of MP Materials. And I think, all I would reveal from that conversation is he would agree, as a U.S. taxpayer, the U.S. government is being thoughtful. And, none of this is rubber stamped. None of it is just throwing, good money after bad. It is thinking of how they can truly move the needle for U.S. mineral independence in a material big way. And we think TMC could eventually be part of that mix.
And that's what I'm hearing. You're not hearing so much about Greenland and Ukraine anymore. I mean, you were a little bit, but so there's posturing and negotiation, et cetera. But when it actually comes down to the U.S. government, picking projects, and I think they're going to do it in a smart way, right? So you got to separate, what's out there political rhetoric wise to actually watch what they do and where the checks kind of come in. And there's a lot of smart people in the government from private industry that are focused on solving the national security problem, but also making sure that the deals make sense for both sides. So, and further, yes, it's been confirmed to me, rather than do 100 small deals, finding 10 big deals that they can do, I think is the preference. So therefore, there's been a lot of rising tide lift all boats in a lot of speculative juniors, because everyone thinks they're going to get an MP deal.
Sure,
but
sure.
The reality is that so from an investment point of view, picking winners, right? You need to kind of understand not only who has good and big resources, but who has kind of the management chops and connectivity to actually sign these deals. So with that, Craig, thank you very much for coming again. Always a pleasure, and this time in person in a cool kind of venue here. Next time will more likely be through the screen again. But it was a great opportunity and thank you for taking time to come into the studio.
My pleasure, Howard. Matt, good catching up.
Good to catch up.
Okay, and for our final guest, we're now going to talk lithium, our past, present, and future. Always excited to talk about lithium. And this week, some stocks were down. Like Pilbara, I woke up one day, was down 19% on CATL's, the news, rumors. I haven't even had a chance to digest this, but to talk through this, we'd had a Spaces 2.5 hours Spaces on X, and I try to get our current guest, Lithium Royalties CEO Ernie Ortiz, to join in that. Was unable to, but very happy now that we can get him for 10 or 15 minutes to talk about that news and anything else. But before doing that, Ernie is a sponsor. Lithium Royalty is a sponsor of RK Equity and Rockstock channels. So just wanted to flag that, fully disclaim that. But why don't you tell us what is Lithium Royalty Corp? In maybe 1 minute. Let the audience know we will do a more fulsome, 30 to 40 minute interview with earning in a couple of weeks. But yeah, why don't you summarize it in a minute, and then we talk about lithium markets.
Sure. So thanks, Howard. Good to be here. Lithium Royalty Corp is a publicly traded royalty company. We're traded out of Toronto. We have 35 royalties today. Our marquee royalty today is Sigma Lithium, but we expect additional producing assets in the near term, like Zijin miNIng, Tres Quebradas is going to ramp up later this year. Also, Ganfeng Lithium's Mariana project was inaugurated in February of this year. So we do project these new kind of cornerstone assets to continue to drive the growth for LRC. And we do have additional development assets that we're very optimistic about, including the likes of Core Lithium, Winsome, and Atlas. So we're 10 employees, so it's a lot of leverage to the commodity price and the additional volume growth. And yeah, we're excited to continue to deploy capital into the space and support the industry.
One thing before we get into that when you described that just reminded me, Matt and myself are very focused on kind of like the low-cost producers, and Sigma is one of them. But what we have noticed in brine versus hard rock, there's not a lot of ways to play Argentine brines, and we've talked about Lithium Argentina and Galan Lithium and NOAA Lithium, but you just mentioned exposure to two very significant operations in Argentina that are controlled by the Chinese. So lithium royalty as an equity, as a means to play Argentine brines, is one thing our audience can consider as an alternative to those individual assets. And it's also a diversified portfolio relative to an ETF that might have a mix of lithium and non-lithium companies.
And I think the other thing about a royalty company is you're taking out the operating risk, aren't you? You're taking out the operating cost risk. So you're basically focusing on the production growth from a really exciting sort of region. So yeah, it's a really interesting way to play the industry.
And these two assets are fairly important in the Argentine scheme of things. I mean, globally, of course, but Argentina, 20,000 tons for phase one for Zijin, for Tres Quebradas of lithium carbonate. Then for Mariana, it's about 20,000 tons of lithium chloride for the first phase. And they all have plans to expand eventually, of course, as the market recovers. So correct, it's a lot of optionality to low-cost brines. And a lot of the assets in Argentina are in Chinese hands. And we're probably one of the Western ways to play this potential growth in Argentina.
Awesome. Okay, so what is happening in the world of lithium? Prices are up. The summer was great. My portfolio of more than a dozen lithium companies is doing great, and I haven't looked at my portfolio this week.
Well, is that out of choice, or
Yeah, it's been a very volatile last few months, especially after the August 9th closure or suspension of the CATL mine out of China. So that's certainly been quite volatile. And I think, as you alluded to it earlier, there's a lot of reports, a lot of noise as to when that mine restarts. I think from what we've seen is it could be as early as October. Now I think some reports today are saying it could restart in November. There's certain investment banks that are also saying it could last up to 12 months. So there's a lot of noise, and it's hard to know what has more validity and who to trust. But I think one of the key elements that we look to is just what's demand growth actually doing, because that's what's really going to ultimately balance the market. And we're very comforted by the fact that demand growth seems to be on the order of 28-30% a year so far for 2025. Meanwhile, you're going into a period where supply growth is diminishing. So I think our view is that the market's on a rebalancing path. And of course, if we get any additional supply cuts, particularly out of these Chinese mines out of Jiangxi, that could just accelerate the market a lot faster than expecting. But we do expect base case to be much better year in 26 and 27.
And do you have a view about Chinese capex? Because obviously the big unknown and the big risk in the lithium markets over the last 2 years has been the amount that the Chinese have added domestically and in Africa. Anecdotally, we've been hearing probably over the last 6 months or so that the Chinese seem to have dialed back on their capex plans, having initially not dialed back earlier on in this sort of downturn. Do you have any sort of visibility as to what the Chinese companies are looking at doing now?
Sure, and that is a great question. And our board was actually in China in May of this year. We met with several of our counterparties who met with battery producers, and I think they did allude to that in a lower priced environment, they wouldn't necessarily want to be as aggressive towards investing in lithium. Not to say that they're going to be out of the market completely, but just you don't have the same sort of momentum or need for speed to continue to invest in the space. So we have seen that deceleration, maybe not as much as we've seen it from the West, especially I think Albemarle's capex is down 60% year over year. Probably not to that extent, because you are still seeing levels of investment from the Chinese, but you have certainly seen a slowdown and slowing down of capex from the Asian parties.
Yeah, and are you looking? I mean, when you look at sort of royalty projects, are you looking globally? I mean, do you look at Africa, for instance, the Chinese projects in Africa? I assume that China's kind of a closed box for royalties, but where are you looking outside sort of the obvious lithium producing regions?
So I think we try to stay in pretty safe mining lithium jurisdictions. So our core geographies, we call it the ABCs of hard rock: Australia, Brazil, and Canada. And then in brine, we do have exposure to Argentina. So those are our preferred jurisdictions. That's not to say we won't deviate from that, but those will still be probably the main drivers of our growth. We do have a royalty in Serbia. We do have a royalty in Finland. We have a few in the US. So I think for us to deviate from our core geographies, we'd have to see a pretty compelling opportunity. And by that, I would mean very attractive returns, likely a cash flowing royalty. Although there are some royalties, some areas of the world where we probably just wouldn't go kind of regardless of the quality of the opportunity. But if there's a good asset, low cost, good jurisdiction, and the returns are there, and kind of cash flowing or near-term cash flow, we'd consider it.
And what about sort of sort of vanilla sort of technologies? So are you focused on sort of salar brine that doesn't need DLE and on spodumene? Would you look at DLE brines? Would you look at sedimentary projects?
Yes, well, so we would. We wouldn't do I guess a blanket statement that we're going to invest in all DLE projects. So I think we take it more from an asset perspective. If the DLE technology we think makes sense for that particular asset, such that on the cost curve is going to be well positioned and has a high grade enough to begin with, then we think it's just probably an interesting opportunity. Even now, Lithium Argentina is testing DLE within their own brine. I think other major producers are trying to use DLE to expand the recoveries and improve the overall production process. So I would say, yes, we're not opposed to DLE. That's not to say we're going to invest in every DLE project, or that's it kind of opens up a whole bunch of new projects. That they would still say it's very asset dependent, has to be kind of a good grade, low cost. And if it happens to have DLE, and then it just is part of the overall pros and cons of the asset.
Okay. Let me build on that. And again, we're going to interview you in a couple of weeks, so appreciate the LIRC strategy specific questions, but want to focus more broadly on markets. The spaces discussion, for whatever reason, there are a lot of people on there, and there was one guy who I know well, has visited China recently, just a retail investor, but very sharp, made a lot of money on Tesla, and has been doing a deep dive, into lithium, and in particular the question on, DLE, and his view and others on that panel were generally like DLE is still 8 to 10 years in the future, even in China. Then I asked him about well, what about SQM? Right, because they're Solar Futuro, right? I don't know what their recoveries are, 30-40%, but and they have been a major source of supply outside of lepidolite and African hard rock. A major culprit for the low prices has been SQM's aggressive ramp up conventionally, so that they're not going to be able to ramp up that fast conventionally. But if they were able to crack the code and increase, recoveries from 30 to 70%. There is risk with SQM, so DLE on conventional high-grade solars, and then there's been a lot of activity in the Smackover and Standard Lithium. So just as a threat to supply, I mean, you've been talking about a lot. Demand's growing very fast, and it seems like you have similar views to YJ Lee, who we've had on this program. Just like, hey, look, demand will absorb all of the supply, but how do you view, apart from where you may invest in royalties, I guess, risk to the lithium narrative and demand overtaking supply? If I know you said it's asset dependent, but you haven't made any investments in DLE. royalties, but it is a risk to your portfolio.
So I'm not sure if it's necessarily a risk. I think it's to what I was saying before, as far as very asset dependent. Just because an asset adds DLE doesn't mean that the asset is suddenly more attractive. And in some cases, we've seen that the cost of production or even the capex could even be larger for DLE assets as compared to conventional, and that's a function of just where they are from a grade perspective, from the geology, and so forth. I think we've seen some of the capex numbers from some DLE aspirants, and they're $50,000-$60,000 per ton capex intensity. So I wouldn't say, like I said, it's not a blanket statement. There are producers even today, like in Shanghai, that are using DLE. I guess we know the Hombre Muerto uses hybrid DLE. We'll see how Eramet ramps up, but they're also an aluminum absorption process, and we'll see how that ramps up. So there are DLE producers today, and just because the DLE technology may work on one asset doesn't mean it's going to work on others. And even the whole within DLE itself, all the technologies are somewhat different. So it does have to still be tailored to a particular asset. So I think just because it may work on one particular brine, it doesn't mean that it will work as well or will work at all in other brines. So we don't see it as a particular risk to supply. And from what we've seen, the cost of production for a lot of these DLE assets, they don't seem to be much better to conventional, and if anything, could actually be higher than conventional. So we'll see what actually is the effect on the cost curve.
Okay. And do you see the advent of the Exxons, Equinor, Chevron, Coke coming into the space? Big balance sheet, low cost of capital. How serious and how committed do you think they are to enter the lithium business?
Good question. I do think they have a big balance sheet, and it's probably tough for me to say. But I think they're committed. They're great companies, and I'm sure, given their balance sheet, they're probably going to achieve success in the future. I guess it's just a matter of how long it's going to take to get those assets into production.
And how about, how those non-conventional assets potentially could impact the cost curve? I mean, you talked about them maybe coming in. I think there's a perception that DLE goes in the first quartile with brine. Mm-hmm. My perception is it maybe goes in the second or third quartile, being more expensive than a sort of pure salar brine. Sedimentary, again, there's a perception that goes in the first quartile, or maybe it goes in the second quartile. Then how does that impact the cost curve from your point of view?
I probably more aligned with your view that not every DLE asset will be first quartile. I mean, in fact, probably the Shanghai brines today that are using DLE are some of the more higher cost brines in the market today. So probably second quartile, potentially even mid kind of third quartile in some cases. And I think you're seeing, I guess we'll see how the Eramet process ramps up to see what their cost of production end up being. And of course, Hombre Muerto is a great asset, but even though that's hybrid DLE. So I don't think, like I said, it's very asset dependent. Not every DLE asset is going to be in the first quartile. So I don't think it's going to change the overall mix of the cost curve all that dramatically. You're probably going to have the same slope of the cost curve continue to grow just because we need low cost supply and high cost supply, just given the demand outlook that is in the market.
And I guess another question sort of on where we are at the moment. By my numbers, the Chinese lepidolite industry is running at something like a 30% capacity utilization at the moment. So what is the risk that if lithium prices do move higher, we'll see more Chinese lepidolite projects come back into the market, from your point of view?
I think that there is a risk, and of course every cycle is different. Not only probably the Chinese lepidolite assets, but also the Australian mines that went into care and maintenance. It seems to be that probably in that $1,200 per ton range, maybe plus or minus $150 per ton, is probably where they would consider probably restarting or thinking about adding tons to the market. So I do think that there's probably a level where companies decide to re-enter, but at the same time, there's been very little greenfield investment in the last 2.5 years. So sure, we may have that ability for the restarts and maybe some quick kind of producer expansion or debottlenecking to try to help feed the coming demand. But if you look out to late 26, 27, there's very few greenfields coming online at that point in time. So you're going to need, you probably then start thinking about further incentivization of new projects.
And the sort of $64 million question then, or maybe billion-dollar question. What do you see as the sort of shape of the recovery in lithium prices? Do you think we're going for a slow and stable recovery, just sort of bouncing up sort of over time? Do you think it's going to be cyclical? How do you see the lithium price moving? You don't have to give me exact levels, but just sort of,
Sure. So I think it's tough to say. One thing I would say, looking at historical cycles, we've seen, and they normally last 2.5 to 3 years. So if in fact we did reach a bottom, I'd say in June of this year, so to suggest maybe the peak kind of late 27 or 28 for the next kind of just real tightness in the market. That probably aligns also with what maybe consensus is thinking as far as when the deficits really start kicking in and so forth. And then as far as just the velocity or potential return of pricing, it's hard to give kind of specific timing, but I would say I probably think about it in levels. And one of those levels would be that $1,200, $1,300 per ton level, which at that point probably does restart some of the Aussie mines and maybe some of the mines that haven't ramped output that dramatically at this point in time. But we would benefit greatly from that because we have a few mines that are carry mains in our own portfolio, so we'd have leverage to that as well. And then once you kind of absorb that potential restart at those levels, then it's really going to be really demand dependent to see how much it can overpower supply, and then we could have a potential kind of real potential aggressive cycle. But it's tough to say how high it could go.
So you're not going to say if it's going to go back to $80 a kilo?
No comment.
And in what time frame?
Yeah.
Okay, that's always the perfect way to end a conversation is on price and outlook. But when we interviewed you at Fast Markets last year, we called it I think radical optimism. From Dua Lipa. But we'll see when we interview you in a couple of weeks. I have an idea of what I want to call it, but we'll see what the market looks like at that time. But so all of our viewers, Lithium Royalty trades on the Toronto Exchange, ticker symbol LIRC.TO, and you could follow Lithium Royalty on X at lithium_royalty, and they also post regularly on LinkedIn, so I would encourage you to look there. So thank you, Ernie, and and thank you for your sponsorship, and look forward to having you on soon.
Great. Thanks, guys.
Cheers.